Hello, everyone. Welcome. I, I can't believe this is finally happening, right? We've been trying to have this reunion. Yes. We'd announced it, of course, in the very auspicious time of spring 2020. And we've had to postpone it year after year, but it's so wonderful to finally be here together, this inaugural MBA reunion. And thank you all for coming back. And it's just wonderful to see so many faces, some familiar, some that I don't know, maybe some that I may have taught. Don't worry, I didn't look up your grades. So it's just great, very, very good to have you here. So anyway, what better way to kick off the reunion than have President Neel Kashkari, who is president of the Federal Reserve Bank of Minneapolis, to talk to us today. He's just come back from the Federal Open Market Committee meetings. I'm sure all of you noticed that something happened yesterday with interest rates. And I'm sure so he'll have something on his much on his mind to talk to you about that. And but I just want to kind of give you a little bit about his background. He's had one of the most interesting career journeys that I can think of. He started off as an aerospace engineer. He's an actual rocket scientist, and he used to design systems for NASA, if you will. And then from there, he did an MBA at that school, which is, I think the Wharton School or something, but that's okay. And he goes on to Goldman Sachs for a bit, and then from there, he joined the Treasury ran the Troubled Asset Relief Program during the financial crisis of 2008. So really, I don't think there's anyone better qualified to lead monetary policy in these times than my dear friend, Neel Kashkari. I have to tell you, I suppose I'm your boss, right?
You are.
Yeah.
There's not suppose. There's no ambiguity about that.
There's no ambiguity about that. I am his boss. So I'm told I'm the only person in the country who can fire him, actually.
That's true.
So I'll keep you on, I'll be watching how you do today. So
and if you check Twitter out, there's some people who are urging you to do that. So.
That's why I don't pay attention to Twitter. Anyway, so, and what was very interesting too is that after his stint at the Treasury and a brief stint at PIMCO, he actually ran for governor of California on a platform focused on economic opportunity. And that's something he has continued to do at the Fed as well, created the Opportunity and Inclusive Growth Institute, which has been a real winner for us. And one of the things that people don't know about him, everybody knows that he's an amazing communicator. And, one of the best communicators, I believe, in the Fed system. But he, speaking at length to Washington Post, New York Times, and every TV channel that you can possibly imagine. But I think what some people don't know about him is what a good manager he is. Internally, within the Fed, he has improved the morale of that institution tremendously, and has done so much also to promote diversity and equity and inclusion all across the board at the Fed. This is something that I'm very proud of with you, Neel. I'd love to give you a round of applause for all that. Anyway, his undergrad was from another Big Ten school, so he's a Midwesterner. He grew up in Ohio and went to Illinois for his undergrad degree, so we won't hold that against you. But anyway, thanks for joining us today, and let's, take it away.
Great. Well, thank you, Sri. It's great to be with you. Great to be with all of you. By the way, by coincidence, this is also my 20th MBA reunion. I'm not journeying back to Philadelphia, unfortunately, for that. But I'm happy to be. I'm going to share in your celebration of your MBA reunion. I'll just spend a couple minutes just talking about what the Minneapolis Fed does, what we are, why there's a Minneapolis Fed. And then I'm going to turn it over to Sri, and we'll have a discussion, and we're going to open it up to all of you to have a Q&A. And just do me a favor when you ask your question, and please don't hold back, ask anything you like. Just do me a favor and introduce yourself. But be warned, we're live streaming this, so you're going to be introducing yourself to a lot more people than just those in the room. But that'll make it interesting, I think, for all of us. There's something unique. Obviously, the Federal Reserve is our nation's central bank. There's something unique about our central bank, which is when it was created in 1913, created by Congress, they said, we don't want it simply housed in Washington, D.C., under the direct control of all of the elected officials. They wanted it distributed out across the country so that all the regions of the country had a voice in the monetary policy process. So they created the Board of Governors in Washington, D.C. You've probably heard of our chair, Jay Powell, and before him was Janet Yellen and Ben Bernanke and Alan Greenspan. They're appointed by the President of the United States, and they're confirmed by the United States Senate. But then they also created 12 independent regional Federal Reserve banks, the 9th of which is here in Minneapolis, the Minneapolis Fed. We represent the 9th district. So what is the 9th district? It's Minnesota, North and South Dakota, Montana, the Upper Peninsula, Michigan, and northwestern Wisconsin. A big part of our jobs are to know what is happening in our regional economy. And by the way, that's a big region in terms of geography. And bring that back to Washington, D.C. when we debate monetary policy for the nation. So I went to Washington. I go now. I mean, we went virtual for a couple of years, but we're back in person. I'm happy about that. I think we all are. I go every 6 weeks for FOMC meetings. And part of what I'm doing in those meetings is talking about what's happening in our regional economy. Now, each of those 12 Federal Reserve banks has a board of directors, and that's where Sri's role comes in. There are 9 directors where we try to get directors from across the district that represent the different geographies, that represent different sectors of the economy, that are leaders in their sectors, and that can bring intelligence, not just their own insights, but through their networks of contacts, bring that to our board of directors meetings when we deliberate on the economy. And then I take some of that information, I put it in my head with the analysis of our economists and my own outreach to communities, and then I take that back to Washington, D.C. So our boards of directors serve a very, very important purpose. And Sri has been a terrific director who's been chair now for a few years. Great job as director, great job as chair. And one of the things that's really special about Sri, in addition to her own academic and her deep insights into the economy, being dean of the Carlson School, she has a terrific network of contacts of business leaders across our region. So regularly, Sri will be reaching out to her contacts, and I'll pose a question. I'll say, hey, what's happening to wages across our district? What are businesses seeing when they're bringing in new employees? So we'll send a question. I'll send a question to Sri and the other directors, and then Sri will work her phones and her meetings and reach out and then collect that and then distill it and then bring it back to our process. So it's a very organized, both informal and informal process to get as much information as we can. And we're just grateful that Sri and her colleagues on our boards take it so seriously. We're able to attract people who really believe in the mission of the Federal Reserve, the public service mission, and it makes it an effective process and an important part of our process. So I just want to say thank you for that, Sri. So meetings like this are great for me because they're an opportunity for me to share with you what I'm thinking, what we're seeing in the data, but also to hear from you. So I hope that when we go to Q&A, that it's not simply questions for me, but it's also comments. If you hear what I say and you disagree with it, love to hear that. Or you think we're missing something important that you're seeing in your part of the economy, love to hear that too. It's a chance for me to learn from you, so thank you for that. So with that grounding, Sri, why don't I turn it over to you?
Thanks, Neel, and I have to say that being on the board of the Federal Reserve Bank of Minneapolis and chairing it for the last 2.5 years has been just such an interesting time to have been on the Fed board. So I'm just very grateful to have had this opportunity to be there. But so Neel, you just came back from this FOMC meeting, and I know that the Fed raised interest rates 0.5 percentage point yesterday. What was the thinking behind it? I know we're all kind of concerned about inflation. Was this enough? Was this not enough? What do you think about the course of interest rates and inflation in this country?
Well, many of us at the Fed, myself included, believe that the high inflation that we started to see in the second half of last year was what we call transitory, which is the economy went through a rapid shutdown and then a rapid reopening, and the demand side of the economy was reopening faster than the supply side was able to catch up. And because of the nature of the pandemic, the services sector of the economy got really shut down hard. People couldn't go to restaurants or get on planes, so they spent a lot more money on goods. So the mix of services and goods shifted towards goods. So you had these factors that we believed would unwind, but they have not unwound as quickly certainly as I expected. And so when you have a mismatch between demand and supply, you end up getting higher prices, too much demand, not enough supply. So we've really pivoted our posture towards monetary policy and begun tightening monetary policy or taking away the way, the support that we're giving the economy. So yesterday or 2 days ago, we raised the federal funds rate by 0.5 percentage point. That's on top of the 1/4 percentage point that we did it in the prior meeting. So we've raised rates 75 basis points, as we call it, which seems like it's not very much. People say, oh my gosh, you've only raised rates 75 basis points and inflation's at 7%. You're way out of line, because real interest rates, which is the nominal rate less inflation, are still deeply negative by that measure. So they say you're just way behind. Well, that's really misunderstanding how monetary policy works. Monetary policy works through what happens to long-term interest rates. If you go to buy a house and you want to go get a mortgage, you don't really care about what the overnight interest rate is that banks charge each other. I mean, who cares? You care about what interest rate you're going to pay over the life of your mortgage, whether it's 10 years or 15 years or 30 years. Or if you're a business considering building a new factory, again, you don't care about what an overnight interest rate is. You care about the interest rate, the cost of capital over the life of your project, which is probably 5 years or 7 years or 10 years. So it turns out, while we've only moved these short-term interest rates a little bit, and we haven't yet started shrinking our balance sheet, we've actually moved long interest rates a lot. Well, how does that work? Well, that works through something we call forward guidance, which is the Fed has established a lot of credibility with market participants. And when we signal, hey, we are on a path to increase interest rates over the course of the next year, markets adjust and price that in right away. So if you look at mortgage rates as an example, mortgage rates have rocketed since the beginning of this year. The 30-year mortgage rate was around 3. It's now around 5.25%. It's a dramatic increase in interest rates, much higher than the short-term interest rates that we have moved because of that forward guidance. And so I just published a piece this morning. It's on our website. You can probably find it on social media, where I lay out these arguments and the difference between nominal and real interest rates and between short-term and long-term interest rates. And in my view, the interest rates that really matter in terms of driving the economy are long-term real interest rates. And we've moved them quite a bit. Now, have we moved them enough? I don't know. It really is going to depend on what happens on some of these supply issues that I'm sure you read about. The war in Ukraine is devastating for their people. It's also disruptive for global supply chains. The pandemic in China and their zero COVID policy, also very disruptive for their people, but very disruptive for global supply chains. And so if we don't get any help in terms of supply chains normalizing, then we're going to have to do more with monetary policy. We can't boost supply with monetary policy, but we can bring down demand. And when demand is exceeding supply, you hope that supply comes online. If it doesn't come online, we're going to have to bring demand down to get inflation back in check. But I'm confident that we have the commitment to do what we need to do to bring inflation down. I just hope we get some help on the supply side.
You mentioned real and nominal rates. I mean, how do they influence, economic policy or economic growth? I mean, what's your take on that?
Well, when someone takes out a loan or someone makes a loan to somebody else, you care a lot about inflation, right? If you buy a U.S. government bond and you say, well, I think, so the Treasury bond, I think I'm going to get 3% back. Well, if inflation surprises you to the upside, then your purchasing power when that bond matures is less than you had expected. And so the expectations about inflation matter a lot. They're woven into investment decisions, consciously or subconsciously. And so that's why we say real interest rates are really what drive economic activity. Now, I don't want to say that nominal interest rates don't matter. Okay. They do matter. Mm-hmm. When you go to your bank and you're thinking about buying a house, the sticker shock of, if you're used to a 4% mortgage and now the sticker shock is it's a 5.25% mortgage, that can have some effect on consumer behavior. And if mortgage rates, you meet people who were in the markets in the early 1980s, and they say, oh my gosh, interest rates are so low even today compared to what they were used to back then. But you meet younger generations who maybe graduated college 10 years ago, and they're starting to say, wait a second, I'm not used to these kind of interest rates that we're seeing now. So there is a psychology component, and that's why economics is part science, but it's also part art, and it's part trying to understand mass psychology. And all of that is, it's put together imperfectly.
Yeah, but the other side of the equation is that, as you raise interest rates, you also run the risk of driving the economy into a recession, right? So how does this neutral interest rate work? And I mean, a neutral interest rate would be something which neither sort of overheats the economy, but keeps inflation in check, but doesn't sort of throw us into a a recessionary situation. Where do you see that at? What might that be? How do we even figure that out?
Yeah.
What's your take on all of that?
It's a great question. It's a really important question. And it's one of the most important questions for central bankers. Just as Sri said, what policy neither stimulates nor restrains the economy? We cannot observe this directly. Right? We can try to estimate it. And what's even more complicated than this is it changes over time. Mm-hmm. It changes over time based on broader economic factors. So think of it this way. The neutral rate balances the supply of credit and the demand for credit in the economy. So the supply of credit are savers, and then you've got investors. And if people are saving a lot, and there's a lot of savings, and there's not that much demand for investment, the interest rate will be low that clears the price, or vice versa. So we think it has been trending down over decades, not because of central bankers, but because of broader economic factors like demographics. Societies in advanced economies are aging, they're saving more, they're investing less demand for investment. Technology development, trade, all of these things we believe have been driving down these neutral interest rates over time. So that's why you think about, well, if we want to get back to neutral, let's just say as a starting point, we want to get back to neutral. The neutral in the 1980s is not relevant to the neutral today. So that's the first assessment. Then the next piece of complexity is it the neutral rate of the federal funds rate, which is an overnight interest rate, or is it the neutral rate of the long treasury rate or long risk-free rate? So it turns out there are multiple neutral rates across the yield curve, as you could think about it. And so it ends up being very complicated. My assessment is, because we've done so much with forward guidance, that long-term real rates are roughly around neutral today. Now, that means we have to follow through. So we've promised their interest rate, or we've said we expect that there are interest rate increases to come. So the long-term rates have moved a lot. So now we need to walk the walk and follow that guidance to deliver on that. And I'm confident that we will. The question is, do we just need to get back to neutral? Or, depending on what happens on the supply side, do we need to go above neutral? And that's what I think we're going to learn a lot more about over the next several months.
No, that's really sort of interesting and hopeful. I feel very confident the Fed will somehow guide us through this glide path and of a soft landing. That's something that I think everyone is keen on seeing happen, and I feel confident that with the Fed that we have right now and the attention that you pay to data-driven decision making and being really on top of what's happening at any point in time, I think that's a huge, huge plus. So I'm very, I must say I'm bullish on the Fed. So, but moving to a different topic. A couple of years back, you started this Opportunity and Inclusive Growth Institute. What was the thinking behind that? What do you see as some of its successes? And I'd love to hear more about that.
So actually, amazingly, time flies. It's been 5 years now that we launched the Opportunity and Inclusive Growth Institute. So when I came to Minneapolis, the Minneapolis Fed 6.5 years ago, and I started traveling around different communities in the district, and especially as I go into lower income communities and diverse communities, I was hearing from businesses that said, oh my gosh, it's a worker shortage. It's a historic worker shortage. This is even 5 years ago they were saying this. By the way, businesses always say this, okay? One of the things I've learned, they always say we're in a worker shortage because they don't want to have to pay up higher wages. But I'd go into low income communities and they say, hey, we don't have work, or we're stuck in part-time jobs. And then I started examining the data. And one of the curious facts about America, and it's an unfortunate fact, is that black unemployment is almost always twice white unemployment in America. Whether it is a booming economy and white unemployment is 4, black unemployment will be 8. Or it's a recession and white unemployment is 6, black unemployment will be 12. And so I started asking our economists, why is this? By the way, this is true if you compare college graduate against college graduate or high school dropout against high school dropout. It's remarkably consistent. So I just started asking basic questions. Why is this there? Why is this so consistent? What are the explanations, et cetera? And what I learned was, as many brilliant economists as we have around the Federal Reserve, I was surprised how much we didn't know about some of these basic questions of economic disparities, economic inclusion or lack of inclusion, lack of economic opportunity. And that's when I went to actually then Chair Janet Yellen and then Governor Jay Powell, and I said, we, the Fed, need a research center focused on trying to understand these issues. Because one of our goals is maximum employment. As many Americans as possible gainfully employed, contributing to our economy. And if we cannot answer even these most basic questions about structures of the labor market, then how are we going to achieve maximum employment? How are we going to know it when we've achieved it? So I suggested that we set up a research center, and they said, sounds like a great idea. We ended up launching it in Minneapolis. And so the point of this is to, in a formal, long-term manner, try to get researchers from across the Federal Reserve System engaged with other experts around the country and around the world who examine these issues to really try to study these in a formal, rigorous way, ultimately to inform our policymaking and other policymaking around the country. And it's gone very, very well. I mean, we're learning a lot. We bring a lot of scholars in to visit us, experts from other universities or from other research institutions. We learn from them. I think they learn from us. And we are all, we're not going to, these are disparities that have been decades or centuries in the making. They're not going to be solved overnight, but we are going to do our part.
Along with that, I know the Minneapolis Fed and all the system Feds really launched this whole series on racism in the economy, focusing on different sectors, on housing, on education, on finance, and so on, and bringing practitioners, academics, thought leaders from around. Are there any lessons that have come out of that? Is there anything that, out of that series? Will you be continuing that series? How do we think about it?
So this came about after George Floyd was murdered here in our neighborhood, right, in Minneapolis. And I called my colleague in Atlanta, Raphael Bostic, and I said, is there something we could do together to try to bring our expertise to bear, to try to shine a light on these issues, to make a contribution? If ever, we all have to do our part. And I called Raphael because Atlanta is every bit an epicenter of these disparities as Minneapolis is. And we started working together, and then pretty soon all 12 Federal Reserve banks joined. And as you said, we looked at housing, we looked at education, we looked at criminal justice, on and on. I'd say we're still trying to process what we can take from this that we can incorporate into our own daily work. So part of it is going to be how do we do our jobs differently, learning what we have learned. One of my personal takeaways is it's almost impossible for me to unsee the disparities that I've now been confronted with. And it can be everything as simple as trying to understand what somebody experiences when they walk in a bank. When you walk in a bank, what do you see? You see no signs. You see some tellers. You see maybe some computers and some desks, and it's very quiet. If you didn't know what happens in that bank, it turns out it's actually pretty darn intimidating. Now contrast that, somebody showed this in one of the presentations I recall, what you see in a bank versus what you see in a paycheck, cashing your paycheck, like a payday loan lender. Like we have this vision that payday lenders are nefarious, they're fleecing people, they charge these really high fees. That may all be true. But when you go in there, it looks like McDonald's. Here's the menu. Here's what you want. Here's what it costs. Here's where you get it. And it's completely obvious how it works. Well, it turns out the thing that we think is much better for you, going into a traditional bank which has lower fees, the way it's structured is incredibly intimidating for people who have not grown up with it. Or bring it back to education. One of the things I've learned along the way, I've met students, young people, who came from very low-income families. And I said, what were your barriers to go to college? They said, well, college is very expensive. We couldn't afford it. And I said, wait a second. Looking at the income profile of your family, you would qualify for tons of aid. I just don't understand why that would be a barrier. Well, they didn't even know you had to apply. They didn't know how to apply. They didn't know how to apply to college. Nobody in their family had ever done it. For me and my family, my mom was a doctor, my dad was a professor. I knew how to fill out those forms when I was 5. Okay? But if you didn't come from that, turns out this thing is a really real barrier. And if all of us don't come from that, and we're the ones who are designing the structures, we're not even aware that we're creating these barriers. So those are just 2 examples. And so now that my eyes are open, I see them all over the place. And, we all have to do our part to try to, we need to lead to different outcomes, and we need to be more self-aware of what are leading to the outcomes that we're getting.
I think that's, there's great examples, Neel, and I can assure you that, at the school we noticed this as well. And so we've, started programs that go into middle school now to try and get under-resourced students to campus in summer. We bring 150 students every summer. We call it the Business Innovation Academy, and groups of 50. And they and actually just make these kids feel comfortable on a university campus, and and have our own undergraduates and faculty, tutor them and talk to them, and and tell them to stick with the tough courses, give some of those messages, and we continue that through high school through an Emerging Leaders of Color program, where we actually again do some of the things, try and help them fill out these forms, talk to them about filling out financial aid forms. These are not easy. Or, do the ACT exam, help them with that, all of that. So it's just kind of, I think there's so many areas where we just are unaware of the barriers that people face in accessing some of the facilities that are available to them, and how do we make sure that that access is broadly available. So that's something we're working on as well. Well, this is all wonderful, but at the end of the day, I mean, all of us, we'll go about our daily lives. How does the Fed affect us? Is there anything that we should know as regular people? I mean, how does what the Fed does matter to the common person?
Well, it matters. I mean, unfortunately, everybody now knows about inflation. Right? For the 10, 20 years prior to the reopening, most people didn't have to think about inflation. The biggest struggle for central banks prior to the pandemic was that inflation was too low. It was around 1.5%. We were trying to get it to 2%. That was true here. That was true in Europe. That was the conundrum that central banks were wrestling with. High-class problem compared to what we're facing right now. And so it absolutely it affects everybody in terms of what you pay at the pump, what you pay when you go to the grocery store, how far your paycheck goes. So it literally affects everybody. And the thing I want you to know is the people at the Fed, at the Minneapolis Fed, at all the banks, at the board in Washington, they joined the Fed because the one thing that they all have in common, they care deeply about public service. Right? It's not a partisan institution. It's an institution that attracts people, whether they work in our law enforcement area or our human resources or our bank supervision or our economists and monetary policy. They are interested in public service. And so I actually think if more people got to look behind the curtain and get to know and meet the people who work at the Fed, I think most Americans would be really proud of the institution and the people that we're able to attract and the mission-driven culture that we have. So we're not perfect, as you know. We are going to make mistakes, but I can tell you everybody is working very hard to look at all the data that we get in and to try to make the best decisions we possibly can to achieve the outcomes that Congress has given us, which is stable prices and maximum employment. And this pandemic is something like none of us have ever lived before. The last big one in America, obviously, was 1918. And the shutdown and the reopening and the fiscal stimulus, there's a lot that our models were not set up to try to understand, or they didn't understand them very well. And so we are constantly learning and adjusting. And I'm proud of the fact that the committee has made a very sharp turn. We were not dogmatic and said, we looked at the data, and when it came in differently, we changed our views. And that's what we should do.
Thank you, Neel. And now we'll open it up to questions. And I know we have folks with mics. Annalise, there's a mic out there, so please. There's a question here.
Good morning, Matt Hunt, MBA 97. You were talking about economic disparity a little bit ago, and you rattled off a number of different areas where we see disparity. One of them you didn't mention was healthcare. Knowing that healthcare is one of the biggest causes of bankruptcy for this country, I'd love to hear your thoughts on what the role of healthcare is in economic disparity.
I mean, it's all of these are linked, right? I mean, they are all linked. What you said is absolutely correct. Yeah, and there are many facets of healthcare disparity. Just taking Minnesota, for example. There's one of the disparities is not simply income disparities, it's geographic disparities. Because you live out in a rural community, oftentimes getting access to quality medical care, or even, we're not talking about cutting edge stuff, even basic obstetricians. If you're a young family, my wife and I have a 1.5-year-old and 3-year-old. We're very fortunate to be in the Twin Cities and have access to great doctors for my wife and for our kids as we're going through the pregnancy. So where you live also matters a lot too. And then just the simple fact of whether you have insurance or not is such a, I remember for the delivery of one of our babies, I can't remember which one, maybe it was my daughter, I got the bill from the hospital. And the bill showed something like, or from the insurance company, the price they charged the insurance company was $12,000. The price they charged to us, I don't know, it was very small, like $500, something like that. The price, the insurance company got a negotiated price of $12,000. The unnegotiated price was $28,000. So if you were the family that did not have insurance and you had a baby and you went to that hospital and you got the exact same care we got, you got hit with a $28,000 bill. I got hit with a $500 bill. So how do you address that? And these are just vexingly complicated issues. But again, the disparities that we see manifest themselves in almost every sector of life. And that's why we have to just chip away at them.
Thanks.
Phil Miller, also class of '97. I'm just curious, you were addressing, the Fed has sort of a dual mission of full employment and, stable monetary policy, or however you want to frame it. I'm a history major, I don't get that exactly right. How do you think, we've talked a lot about inflation, how do you think about balancing right now kind of the growing, we just had another 450,000 jobs created based on the report that came out this morning. How do you think about the balance of that? And it also gets into equity, inclusion, and full employment as you think about taking rates up while trying to also maximize employment.
Yeah, good question. In an ideal world, these two things, we'd achieve them both at the same time. Something close to maximum employment, or whatever we think maximum employment is, and that's another thing that's hard to know exactly when you're there, and stable prices that we define as 2% inflation. Prior to the pandemic, I was one of the lonely voices arguing that monetary policy was too tight, that our interest rate increases didn't make sense. I argued that because we were undershooting on both sides of our mandate. I didn't believe we were at maximum employment, and we were undershooting inflation. So why were we raising rates? I kept asking this question. It was like a free lunch, so to speak, if you're undershooting on both sides. Ideally, these things are like a seesaw, or you think that they're like a seesaw, which is if the job market gets really strong, the unemployment rate drops, wages go up, that leads to higher prices, and then you bring these two things into balance. So I would say right now, by most measures, the job market is very strong. And we're at a time of very high inflation. So my assessment is we know we have to bring inflation back down to 2%. And if the job market softened a little bit, that's not much of a trade-off. The challenge is going to be if the supply chain issues don't help us, if they don't unwind a little bit on their own, and we have to use aggressive monetary policy to bring inflation back down, then that could lead to a higher unemployment rate. That could lead to a recession. But here's the thing. This is what's so unfair about the economic system, so to speak. If we cause a recession, it's disproportionately going to hurt the lowest income workers who are most recently the ones to get hired. They tend to be last hired, first out, so to speak. But if we don't get inflation under control, they are also the ones who are most being hurt by this, because I might get annoyed when I go to the grocery store and I see higher prices when I buy things for my family, but I can afford it. But if I'm paycheck to paycheck at the lower end of the income spectrum, it disproportionately affects me. So we have to do our very best to try to get this right and achieve our dual mandate. But allowing inflation to embed itself in the psyche of the country, that ends up being very, very, very painful and costly to the economy as a whole. So that's why I'm confident that we have the conviction to get inflation back down to 2%. I'm just hoping we get some help along the way so we don't have to do all the work.
following up on that, maybe I'll just ask a question in between, which is that, one of the things that you had mentioned about unemployment, I mean, the pre-pandemic situation, and the reason why you were constantly saying, we're not, inflation is still below 2%, and yet unemployment is quite low. But one of the things that you kept pushing on at that point was that there were people, the labor force participation at that time, there were still people coming into the labor force, even way beyond what we expected. And so what's the situation now with that, with labor force participation?
So it has, a lot of people left the labor force when the pandemic hit. There were shutdowns, the schools were closed, especially a lot of women left the labor force who had childcare disproportionately fell on them. My wife got laid off, and so we took our daughter out of daycare. And so my wife left the labor force, so to speak, for a year, and has since come back in. The labor force has recovered substantially from where it was prior to the pandemic, but not fully. And so I do think one of the things that we kept getting surprised by before the pandemic hit, businesses kept telling us, historic worker shortage, there are no workers out there. And they were slowly raising wages. And guess what happened as they slowly raised wages? Workers came off the sidelines. Turns out there were more workers out there than we appreciated or businesses appreciated. People were responding to price. And so that was one of my takeaways, is most people want to work if they can get a decent wage at a job that they like. So I still believe that's true, but now it was easy for me to take that position when inflation was low. Now that inflation is so high, we know we have to bring inflation back down. So I'm still optimistic that we will see continued increase in labor force participation. More people will come off the sidelines, but I also know we have to get inflation back down.
Hi, I'm Michael Brousseau, also the class of 97. I guess we're kind of dominating questions right now. We'll pass the microphone around in a second. If your balancing act does its trick, what are some of the indicators that we will start to see as consumers beyond the price of gas starting to come down? What are the sorts of things that we will be looking for to know that inflation is beginning to come in balance, that it's getting back down to maybe that 2%? Before it actually gets down there. So what are the indications that you may be looking for, and what might we see as consumers?
Well, one thing, so by the way, how are those inflation numbers calculated? There are government economists, not at the Fed, who created a basket. They call it the basket of consumer goods that most families buy. And they're constantly updating the basket and going out to retailers and looking at what people are really paying. So you should see it across your own experience just as you live your daily life. The first place you will see it, I'm confident, is in housing. Because we directly influence mortgage rates. I talked about that earlier. And mortgage rates directly affect the affordability for people to buy homes or to build homes. And so you should start to see these tighter monetary policy leads to higher mortgage rates, leads to some cooling off of the housing market. That would be the first place that I would expect to see it. So one place you've already seen it is refinance activity has fallen like a rock, because a lot of people refinance when rates were 3%, now they're at 5 or more. They've like, okay, this doesn't make sense for me to refinance anymore. So that's already taking place. Home prices have not yet softened, but I would expect home price growth to at least start cooling off. I'm not projecting that home prices are going to fall, but I am expecting that home prices are going to stop climbing as quickly as they've been climbing over the past couple of years. So that would be the first place that I would expect to see it. But hopefully you will see inflation start cooling off across your own family basket of goods and services that you buy, whether it's airplane tickets. I bought tickets lately, are quite high. Hopefully we're going to see some softening there as well.
Okay.
Oh, back there.
Yes, John Pennington, class of 2012. I'm thinking of something that's, I guess, a little bit of 1990s nostalgia. There's a term I heard a lot, the NAIRU, non-accelerating inflation rate of unemployment. And I remember that being like the central concern of the Fed and policymakers at that time. And you also had at the time a lot of increasing productivity in the economy due to the internet and also due to the sort of revolution in logistics and supply chain that Walmart helped create. And I'm noticing, I guess, now there seems to be a lot different phenomenon going on right now where you have all these disruptions to supply chains, but also you have the great resignation going on because the pandemic disequilibrated the labor market. An industrial and organizational psych colleague of mine made me realize that it's a bit like what the pandemic did is a bit like everybody in the American workforce having their class reunion at the same time. Because often people switch jobs around the time of class reunions because they take stock of themselves. Well, a deadly pandemic causes that kind of stock taking, and it causes it to happen collectively over the entire American workforce, and not just with one person over here and one person over there, like one class reunion would. Would you say that the combination of these things, the supply chain issues plus the Great Resignation, would the two of these factors make the old '90s style monetary policy of trying to hit that non-accelerating inflation rate of unemployment? Do you have to do something different? Do you have to innovate because of the change in the larger macroeconomy that's happened because of supply chain issues and the Great Resignation?
Well, I do think we have to see how these things shake out. And our businesses are very motivated to try to fix their own supply chains, not to help us, just for their own bottom line. So hopefully some of these supply chain issues are going to get sorted out. When I talk to global companies headquartered here in Minnesota, they've been telling me it's like whack-a-mole. They deal with an issue in Brazil, and then something pops up in Argentina or in China, et cetera. So they're constantly chasing these different supply chain issues. And obviously COVID is still a fact of life in America. It's really a fact of life in China. So the virus, let's not forget, is also still really important. So we have to adjust monetary policy while these disruptions are still taking place and before they have fully sorted themselves out. What does the world look like 5 years from now, when hopefully this pandemic is endemic and we're back to something like normal or a new normal? I don't know. I can tell you this. Some of the changes that we're making in our own workforce, for example, we've adopted more of a flexible work schedule, but we've not gone full remote. Like I think a lot of people are overreacting to short-term changes and saying this is now the long-term future. I think we have to wait and see how some of this shakes out, if some of these changes are in fact going to be permanent or not. So, everything you said, I think, is right in terms of these disruptions and these uncertainties, but we need to make policy calls now, even when we don't have clarity on how each of these is going to shake out. The last thing I'm going to say is I don't really buy the Great Resignation. I think a lot of people are switching jobs because they're looking for better opportunities. And so what I've seen is people are leaving the toughest jobs for better jobs. And I'll give you two examples. A lot of people have said you can't find long-haul truckers. It turns out it's easier to find local truck drivers. Long-haul trucking is a tough job. You're away from home for a week at a time or more. Wouldn't it be nice to drive a truck and be able to sleep in your own bed and have dinner with your family? So that's a shift, as an example. Another shift is daycare workers, childcare workers. Childcare work is, I only have 2 children. It is really tough work. If you had a room full of 8 children, I can only imagine how tough that would be. And they get paid very low wages. And so they're saying, well, wait a second, why don't I go to Target and make $15 an hour? It's not as demanding a job, and I get higher wages. So there's a churn away from what I will call not the least important jobs, from the toughest jobs to more attractive jobs. And that's something that we're all going to have to adjust to, because we need long-haul truck drivers. As much as Silicon Valley says, they're all going to be out of a job soon. It's going to take longer than they think. And we need childcare workers. So we're all going to have to make adjustments, and that probably means adjustments in wages.
question here.
Oh, sorry. We'll go to him, and then we'll bring the microphone over to you.
Okay.
Hi, I'm Rand Park. I'm a faculty member here at the Carlson School. Just like to get your thoughts on the increasing role of cryptocurrency in the economy and the potential for maybe a central bank digital currency.
You know, I keep asking a very basic question that as yet nobody has been able to answer. What can you do? What could I do? What could we do as consumers with cryptocurrency that you cannot do today with Venmo, PayPal, or Zelle? I can send anybody in this room $5 right now with Venmo instantly. So what is the advantage of Bitcoin? What can you do? So I've pushed on this, and here's what I've heard. Now, any kind of cryptocurrency, in my view, a government-issued cryptocurrency, needs to be better for consumers and better for authorities. In my view, that's the two-part test. So what could you do with a government digital currency that you can't do with Bitcoin? In theory, you could monitor every transaction. You can't do that today with PayPal or Zelle. Like if I sent you money, the government wouldn't know I sent you $5. You could do that with a digital currency, in theory. Number two, you could impose taxes directly on your account. I can't do that today. You know, if the Treasury wanted to tax your checking account, Treasury wouldn't have an ability to do that. Third, we could impose negative interest rates on you through a government digital currency. Can't do that today. Well, that all sounds fine from the government's perspective. That sounds lousy from a consumer perspective. So I see why the Chinese government is all in on this, okay? So Bitcoin enthusiasts say, oh, Kashkari, you're missing the boat. You just don't get it. That's like if you challenge them with logic, then they just say, you just don't get it. Okay, what do you want? Well, we want the seamlessness of Venmo, instant transaction, but we want the anonymity of physical cash because Venmo leads the trail. Physical cash, I give you $5, there's no trail. Well, that sounds great from a consumer perspective. What government in the world is going to sign up for that? None. So I keep challenging anybody who's excited about this to explain to me what you can do with this that you cannot do today. So the last thing they'll say is cross-border remittances. It's going to revolutionize cross-border remittances. I say, great. My in-laws live in the Philippines. Let's say I want to send my in-laws $100 to buy groceries. So my father-in-law gets a Bitcoin account. I get a Bitcoin account. I send him $100. Great. Seamless. How does he buy groceries? Well, if his grocer has a Bitcoin account, he can buy groceries. So what they're describing is not the power of crypto. They are describing the power of ubiquity. If everybody in the world is on the same payment platform, be it Venmo or Zelle or Bitcoin, all of these frictions go away. That is true. And all of these other countries have to abandon their own monetary policies. So I'm all excited about innovation. I'm just waiting for somebody, anybody, to tell me what is the actual use case that is not getting around anti-money laundering provisions, that is not supporting illicit drug trade. What is the legal use case that you can do with Bitcoin or some other digital currency that you cannot do today? And I'm still waiting. So call me a skeptic. Now, let me say, the Federal Reserve is studying this to try to understand it, and I applaud the fact that we're studying it, but I'm in the deeply skeptical camp.
Hi, I'm Elizabeth Schlater, also MBA class of 2012, and my question is about, you mentioned that one of the goals of the Fed is maximum employment. You've talked a little bit already about daycare and caregiving. And so what is the role of policy when it comes to things like parental leave, like childcare in New Mexico just introduced, some form of a step towards universal childcare. So what's the role of policy in terms of making employment available to all through policies like that?
Well, we have to look at such policies as, whatever the US Congress decides to do or states individually decide to do. Those are inputs into our understanding of what's possible in the economy. So if national child care policy were to change, then that might then flow through and change our estimate of where we think labor force participation can go. That's an input to us. So we don't get to set that. And some people will ask us, well, if we did this, what do we think this will happen? And we're happy to share our analysis if we have analysis. But it is an important input into what we think the economy's potential is. Same thing with, if we improve education outcomes for kids all across the country, then we're going to have a more highly educated workforce. I would think our productivity growth rate would probably be higher if we're able to educate more of our young people with really high quality education. That's an important input into our understanding of what the economy's potential is. Go ahead.
Hi, Ted Angelo, class of '02. Maybe a longer term economic question. Do you foresee a move from globalization to regionalization, given the supply chain and logistics challenges we've seen, dependency on foreign countries for critical minerals and components, as well as the geopolitical shift we may be seeing now between East and West? And what would you do about that?
My guess is, it's like the earlier conversation about changes in the labor market. I think some of these changes are going to become, where they're headed is going to become more clear in a few years. I think it's too soon to draw any firm conclusions. But some initial observations I'll make are that what I'm hearing from large businesses is not, well, we're going to reshore everything, but we need to have a more diversified and more robust supply chain, so we're not so vulnerable to this market or to that market. So if there's one major disruption, all of a sudden we can't get the basic components that we need. So it seems like more of, at least at a minimum, more of a focus on resilience and having backup sources of supply rather than being so concentrated. But I don't know. Beyond that, it's hard for me to predict. I do know that there are some fundamental minerals that are largely only mined in China or in Russia. My understanding for some of these minerals is we could mine them here if we are willing to. Maybe it's more expensive, we'd have more pollution controls, et cetera, but there's been a reluctance to mine some of those minerals here, and that assumption may have to be revisited.
Hi, thank you very much for your talk today, and my name is Dheeraj Khatur, and I'm class of 2021, and I'm an engineer, so my question may or may not make sense. So you talked.
Is it an engineering question?
No.
Okay.
So that's why it probably won't make sense. So you talked a little bit about how inflation and recession affects different demographic groups, right? So we focused a little bit on how it affects the lower income groups. So we got two risks, right? Either we have a risk of loss of jobs due to recession, or we have a risk of higher prices, which are unaffordable. I'd like to hear a little bit about how inflation might affect higher income groups, because let's say if it's the investor class, they might also be affected by higher inflation, right? Because it may change their return profiles and so there are other interests at play here. So that's one question. The second question is that, has anyone considered a different kind of a solution to maintaining these two risks, or let's say, or mitigating these two risks? So if you were to let inflation still rise, but while keeping, not tightening monetary policy, but then provide aid to the lower income groups so that they can afford their goods and services, so that you don't create a risk for a recession. Has something like that ever been considered and found to be infeasible?
Yeah, I'll tell you why I think it's infeasible. Is what causes inflation? It's an imbalance between supply and demand. There's too much demand, there's not enough supply, so you have high prices. If the government then said, well, for, let's say, lower income Americans, we're going to give you money so you can afford these goods, you know what that's going to do? That's going to increase demand even further. And that's going to push prices up even more. So then you end up just chasing, it's like a spiral of prices going up and up and up and up and up. And that's why it's so important that we act to bring this back into balance now, before such a spiral were to take place. There's also the notion of a wage price spiral. Prices go up, employees say, hey, to their employer, you need to increase my wages because I can't afford this anymore. So then they pay you more, then they pass on more prices, and then it becomes a spiral again. We absolutely have to prevent the spiral from taking place, because I don't know anybody in a high inflation environment is very hard for businesses to make investment decisions in. There's even more uncertainty about what the future looks like. There ends up being costs across the economy. I think it disproportionately affects the lowest income Americans, but I think there are costs all across the economy. I mean, the only beneficiary of a high inflation environment If you are highly indebted, then there's that beneficiary of that your debts end up, assuming that they're nominal, that they kind of erode relative to the size of the economy. But the cost to the public writ large are quite high.
Tanya Weber, MBA 06. My question is really focused on the Community Reinvestment Act, because I think that is vitally important to get the capital resources to the communities that need it and the neighborhoods that need it the most. So I was thrilled yesterday to see the Fed, the OCC, and the FDIC proposing a update to the policy so it can really focus on those specific areas. I'm seeking your insights of, we have so many non-traditional banks, firms, you might say, that are out there that are providing significant amount of consumer capital and loans. How do we get that adjacent industry to be party to the CRA policy so we can have a better impact?
Well, it's a very astute question, and it's broader than just CRA. I mean, how do you make sure that these non-bank financial institutions that are acting like banks in many ways are operating in a safe and sound manner and are not taking unknown risks or inappropriate risks with their clients' money, as an example, or making loans, offering products that are not in their clients' interest? So I think that is a big regulatory political question, which is ultimately our political system needs to make some of these decisions, which is how do we have a level playing field for all of these participants in financial markets, and how do we make sure that they're all operating in a safe and sound manner? And so I don't have a good answer for you, because I do think it is a big issue, CRA, but it's a big issue across financial services as well. You know, a lot of the innovative financial services companies say, we're so clever, we've come up with a better algorithm, it's all better, until the economy turns. And then all of a sudden, oops, it wasn't quite as clever as we thought it was. And then how many, you know, I don't really care if their venture capitalists are hurt on the way down, but how many of their customers end up being exposed or suffer on the way down? So these are, I mean, I don't have a good answer for you. You've put your finger on a really important question that we're aware of, but ultimately it's our political system that needs to help make some of these decisions. And same thing back to the discussion of cryptocurrency. Ultimately, if there were to be a central bank digital currency, Congress would need to get involved to say, hey, we think this is a good idea for the country. We want you to do this.
Good morning. Thank you again for all your comments. My name is Cesar Farrell. I am an 87 MBA and 83 mechanical engineer here from the U of M. So, I guess my question, more of a comment, is I'm in supply chain manufacturing in Mexico, and we do a lot of wire harnesses for the OEM industry. And what we've heard from some of our large HVAC customers in terms of the supply chain issue is that the diversifying comment you made is very true. We're doing the same. The fear we have is that we're ordering now from many, many different companies, and we're playing catch up with prices, because every time we order, the supply chain is increasing the prices, or in order to get the product. If not, we're seeing lead times that can be over a year long now to get components. So the large OEMs have to be seeing the same thing. So they're diversifying, they're getting different suppliers qualified. And the comment that I've heard from some of these larger companies is that there is going to be a sudden supply chain inventory excess issue. So we are going to see the demand drop and the supply chain go up significantly, in which case it can lead to some very great problems, possibly leading to recession, as you indicated. So, and they anticipate some of this taking place towards the end of this year. 2023 is what they see happening. I don't know if that's true, but my biggest fear right now is that we're going to see all of this inventory come into us at the same time, and we're not going to know what to do with it, so we're going to drop our prices. And I think other companies are going to do the same thing.
Well, I hear you. That makes sense, and I think we're in uncharted territory, and how these things sort themselves out is going to be, it's not going to be seamless.
President Kashkari, I'm a retired public high school teacher, I was graduated, this was my second career, and so I graduated in 2000 from the U, School of Education and Human Development. My concern was in my cohort of 31 students, I was the only one that had an undergraduate major in economics. When teachers get jobs in high schools, the newest teacher tends to teach economics, possibly business finance, although it's not offered much anymore, or political science. These are areas that I think are very important in our society and in a democracy to make wise choices. Are you at all concerned about the lack of education, not only from the students' perspective, but from the perspective of the teachers that are teaching them economics, personal finance, and political science?
Well, I appreciate your comments. I mean, we know two of those things really resonate in terms of things that we've seen and that we deal with. One is we know that a lot of young people just don't have basic financial literacy to understand, how you get a mortgage, how do you get basic loan products, how do you balance your checkbook. And so financial literacy is a big issue that I think it's been identified. For us personally at the Fed, we have a big issue where, our PhD economists are really important contributors to monetary policy and to our understanding of the economy. And the PhD economics field is it's not diverse at all. I mean, it's really dominated by white men, very few people of color. Women are increasing, but women are also underrepresented there. So I think all the reserve banks and the Board of Governors have a concerted effort to work with universities. We're the biggest employer of PhD economists in America. We have a concerted effort to try to develop a pipeline of diverse people coming into the economics profession, because we will make better decisions if we have a broader range of perspectives sitting around the table helping advise us. So, I mean, I share the spirit of what you're asking, and those are just a couple areas that we've engaged in. I don't have much insight into what the majors are of new high school teachers. I mean, I'll defer to you on that, but clearly we want a broad set of experiences there too. Oh, way in the back.
What are you doing?
You should have worn a step counter.
Thanks. Hi, I'm Mike Eisen. I'm a faculty member here at Carlson. You mentioned a couple of times the forward guidance tool that you use, and then you followed that up talking about how you have to now walk the talk, I guess. I'm curious how specific you get with that, what your sense is for how much additional movement in rates market's already pricing in, and whether that forward guidance hamstrings what you can do in the future, because now markets are expecting you to do one thing, and in order to have a bigger impact, you've got to go even bigger than what that expectation is. So any comments on that would be interesting.
Sure. So every 3 months, once a quarter, we publish something called the Summary of Economic Projections, where every member, every participant in the Federal Open Market Committee puts down his or her estimate of what we think the economy is going to do in terms of GDP, unemployment, inflation over the next few years. And then we put down what we think the neutral federal funds rate is. That's an overnight interest rate. And there's a range of views around that. I'm on the low end of that. I think the neutral federal funds rate is around 2.0%. And if we, at that time, had 2% inflation, that would suggest a 0% real federal funds rate. There's a range of views. I think the top end of the range is around 3% among committee participants. So I think there's general consensus that we need to at least get up to neutral and probably moderately above neutral over the course of this year and early next year. But again, there are a range of estimates on what that means, what neutral looks like. And then how much we would have to go beyond neutral. I think many of us are just waiting to see how the economy evolves, especially around supply chains, around labor supply, et cetera, and what happens to inflation. I mean, the best scenario would be we continue on the path that we have laid out, and inflation really starts to soften and we start to have some confidence that we're getting a handle on inflation. Then that would give me confidence, just speaking for myself, okay, let's get back to neutral and let's see where we are. In terms of forward guidance locking us in, I mean, we always include some language around if the economy evolves as we expect. This is then therefore what we expect to do. If there's some major disruption that we have not seen coming, for better or worse, we would have to take that on board. So what we try to do is we try to describe, hey, this is what we call our reaction function. If the economy does this, then we are likely to do this in terms of monetary policy. And then markets can look at the data and say, okay, is the economy evolving the way they expected? So I wouldn't call it a, we're not tying ourselves to the mast, so to speak, saying, no matter what happens, we're going to do the following. We will take that on board. But given what I know now, I feel very confident that we are going to walk the walk and follow through in our forward guidance.
Thank you. Are we close to any other questions? Okay, I know all of you are dying to get back and catch up with your, folks from your class, and so thank you for being here, and thank you, Neel, for an extremely insightful discussion. I learned so much from you today, but also learned from this group. I mean, I didn't realize that reunions were a time for resetting, just like the pandemics are. Take stock of where you are. Hopefully, you don't get a divorce, right? But I think it is just wonderful to have all of you here, and please enjoy the rest of the day. I know we've got speakers lined up. I think I address you in about half an hour or so. So please do hang out in the atrium. And again, thank you, Neel, for a wonderful, wonderful discussion. I think you deserve a huge.
For me, really appreciate it. Thank you.